Hi guys, good afternoon and welcome to the CNBC-TV18 Mumbai newsroom. I'm Pavitra, with me is Ekta, and you're tuned in to your stocks. We have lots of queries which have come in and we're going to get to that in just moments from now. But for the markets, we're back at the high point of the day, so that's good, around 50 points in the green for the Nifty. The mid-cap index is a little bit softer, so that is not recovered as much, just around 50 points over there. And the banking piece has been under pressure. There are definitely pockets of the market which are holding up well, such as the metals piece today or the energy pack as well. But all in all, there looks like maybe a little bit of caution ahead of that big Q tonight.
Absolutely, Pavitra. Hi. And if you look at specific stocks, that's where the interest is coming in. Yeah. So people are buying specific stocks in today's trading session. A case in point would be Tata Consumer Products, which is up around 5% at this point in time within the Nifty space. And if you look at it on a week-to-date basis already, that stock has picked up around 7.6% in terms of addition to its market cap. Following that is BPCL, but it's a little while away, so it's up around 1%, but there's interest which is definitely coming into the steel stocks as well. And if you look at them, all of these stocks, steel, BPCL, Tata Steel, JSW Steel, all of them have gained anywhere between 4 to 5% already on a week-to-date basis. So there seems to be buying which is coming in on specific counters. Well, joining us this afternoon, we have Rajat Bose on the technicals. We have Sharad Avasthi, who is head of PCG research at SMIFS, to answer all of your stock queries. And I'm sure there might be many to go through in the next 30-odd minutes. Let's kick off the show with Raj Sharma, who writes to us from New Delhi. He holds 30 shares of Prestige Estates at 200 rupees. He's a medium-term investor and wants to know whether or not he should stay invested. Well, Rajat, Prestige Estates, Anant Raj, DLF, the kind of returns people are sitting on, it just equals to probably buying one of their flats also soon enough. So what would you recommend on Prestige? Is it a buy? Is it a hold? Should he probably take some profits off the table?
Well, I would say it's a hold, because after, say, a considerable period of consolidation on the weekly chart, last couple of weeks had been, this week and the earlier week, it had been a phenomenal run. So I would suggest stop loss of 475 and continue to hold. There is no point projecting it, because when a stock comes out of consolidation zone after, say, 1.5 years, because it was consolidating between 400 and 500 and now it has broken out. The minimum target would be something like 675 to 700 in this run. But Prestige can move up, because most of the real estate stocks, at least the better ones among them, are gaining traction, and so Prestige also will perform well. So I suggest that 475 stop loss, and the investors should carry on.
Okay, investors should carry on with his investments in Prestige Estates. Sharad, coming to you on this one, how do you look at it? We had record high sales in FY23, in Q4 individually as well. Is your call the same, to stay invested?
Yeah, I think the call will be the same. He can stay invested. This is one of the better companies on the southern markets, and now gradually the concentration is coming down, and earlier Bangalore was around 85% of the revenues. Now Bombay has also started contributing. So I think over the next 2-3 years the growth rate should be very strong, at least, and even in the long term. And gradually over the next 4 or 5 years, I think the rental business should also become very strong, the way they are projecting it to grow. The retail offerings are very strong. Throughout the lifetime, they have completed some 166 million square feet. And right now, the projects that they're working on are somewhere around 77 million square feet, and the upcoming projects are 97 million square feet. So I think all these two trajectories, particularly the 77 million square feet that's ongoing and 97 million square feet that's going to come in, I think these are projects that are slated to hit the markets over the next 4 to 5 years. And with RERA and everything, I think most of the regulatory issues are behind us, and project completion is going through very smoothly. And demand should be very robust for the real estate part, specifically companies like Prestige, who can develop larger, good mid-income or large income housing projects, LIG basically. So I think it should be very good. FY25, we are expecting the earning to be somewhere around 25, 30 times should easily be possible, 750. Even if you do a discounting for the cash flows and everything, I think 750 could be the target that you can look forward to start with.
Okay, 750 rupees for Prestige Estates. That's the target coming in. So quite a strong target there from Sharad. But nonetheless, let's move on. We have Dhanu Kumar who writes to us and he holds 20 shares of Balkrishna Industries, which he's bought at around 1910 rupees. Medium-term investor and wants to know what to do, whether it's a good time to sell or should he stay invested. Well, a lot of these broader market stocks have been doing quite well. Rajat, I'm going to start with you on this one as well. Balkrishna Industries, do you think that there's further upside from these levels of over 2,000?
Yeah, there could be, because even this stock, after the dream run, quadrupling its value from the lows of COVID lows around 600 or close to that, and it went up to I think 2600, and after that there has been a long period of consolidation in which it has tasted 1800, and now only it is trying to break out. So chances are that Balkrishna will do well. And as it is an off-highway tires. Its products are sold in 120 countries. It's a good company. I mean, if you are a long-term investor, nothing like it. I would suggest that continue to carry on. The projection from a technical point of view would come to something like 2,900 to about 3,000 over the long term. Short term, there could be a lot of volatility in this stock because it has already shot up and then again came down to consolidate. So expect short-term volatility, but it's definitely a very good stock to remain invested for the long term.
Okay, good one to hold for the long term. Let's ask Sharad also what he thinks of Balkrishna Industries. Sharad, we have been talking about this entire auto pack doing well, demand looking good. Do you think that playing it through this route is also a good idea? And for someone who's obviously got in at significantly lower prices than where we're at right now, do you think it makes sense to hold?
Yeah, one can continue to hold because the European operations are one of the major income earners for them. Around 50% of the revenues come from Europe. And we all know that post the Ukraine-Russia tension, Europe has been hit hard. And I think gradually over the second half of the year, calendar year particularly, you would see some improvement happening at the industrial level across Europe. So that should help. 20% revenues also come from the US, where there is a backdrop of the recession and everything. So there is a lot of uncertainty. So there is a lot of curtailment and demand. I think gradually these two areas should start performing. Then 70% of the market comes back to normal. Raw material pressures would substantially ease. They've already eased with oil coming down. Further easing is possible. So that should also help Balkrishna. And obviously, it's a decent company. I think over the next 2 years, though we are not expecting much, we are expecting 6-7% kind of top line growth and 25-26% kind of bottom line growth. So FY25 earnings could be somewhere around 100 rupees. So 25 to 26, 27 kind of multiple is easily possible. So yeah, anything between 2,500 to 2,700, I think would be the fair value for the stock.
Okay, all right. 2,500 to 2,700 is the fair value for that particular counter. That's the word coming in. We have another query. Shalini Jain writes to us from Amritsar with a question. She holds 200 shares which she's bought of Yes Bank, which she bought at 50 rupees. So she's sitting obviously on a significant amount of a loss. And she wants to know whether she can buy more shares. She's a long-term investor, wants to know what to do with that particular counter. Well, Sharad, what would you recommend? Do you think that it's probably a stock that you should maybe avoid at this point in time? Or is it a turnaround story and it could revisit levels of around 50?
50 looks like a very far-fetched thing right now. See, the book value right now is around 14. Next 2-3 years, we expect, even if they performs very well, earnings could catapult to somewhere, say around 80 paisa or 1 rupee per share. So the book value would continue to remain at max around 15-16 bucks. And I think with much better PSU banks, much larger PSU banks also available at 1.25 times, it makes more sense to be there rather than bet on a Yes Bank. If you want to bet on a multi-bagger kind of idea where you can make when you want to make such bets, I think there is one recent listing, Tamil Nadu Mercantile Bank, where most of the numbers have been improving, but the prices have been going down. So that is one stock you can look at if you want to bet for those kind of returns. Because I think for Yes Bank to turn to, say, the previous highs where it used to trade at 2-3 times book value, From the current scenario, I think it will need at least another 5 to 6 years, and even then you're not sure how it turns around. So it's better not to go for Yes Bank at these valuations. I think even at these valuations, if you can exit, it makes more sense. If you want to play it safe, go for something like an SBI or a BOB. If you want to take a bit of risk in terms of price performance only, where Tamil Nadu Mercantile Bank has been going down. So I think numbers wise, it looks very good. So that could be a story that could double your money from here.
Okay, that is an interesting option in place of Yes Bank as well. And I think this is the case with Yes Bank, right? So many people get in expecting that multi-bagger kind of returns, hoping that turnaround story will play out. Rajat, what's your call on this? I mean, this year itself, the stock is down 25%. Do you agree that it's best to get out of this one?
Avitra, at any point in time, if you search the database of prices and technical charts, you will find that kind of base formation. At least in 2025 stocks, you will find them. And out of that, only maybe one, maybe not, will become a multi-bagger. And people are actually running after these companies, thinking that it will multiply their money in a short period of time. That doesn't happen. I completely agree with Sharad that one should switch from this. I would also suggest that switching it, but Tamil Nadu Mercantile Bank could be one option. Another option could be PNB. PNB is a better option. And if I heard correctly, that Madame Jain has only 200 shares. So in that case, loss would not be, in absolute terms, loss would not be that big, but it would be better to get into a better stock. And please do not buy such stocks expecting that they would turn out to be multi-baggers. They simply don't. One or two may happen, but mostly they will belie your expectations.
Okay, all right. Tread with caution. That's the word coming in for stocks such as Yes Bank. But Deepak Dave writes to us now. And from Gandhinagar, he holds 300 shares of SRF, which he's bought at around 2,300. He's a long-term investor, wants to know what to do with this particular counter. It is a far cry from its 52-week high. But Rajat, what would you recommend? Is there any sort of upside from these levels?
I would say that if I could show you the monthly chart of SRF, you will find that SRF actually has been a huge multi-bagger. And after that, what is happening now for the last 1 year or maybe a little more, it is seesawing in the sense that it is going up, going down within a range. But actually, some kind of a sideways correction has happened. Now it is weakening. And chances are that SRF is likely to come down. It's a great company, but a great company may not be a great stock if you pay too high a price to acquire it. So wait, he should exit this counter, or if he doesn't want to exit, then at least take out part of the holding and wait for lower levels. Where I am expecting it to come down to, it may take a year or even more. Even it is in my list of buying. But I would like to buy it between, say, 2,000 and 1,800. SRF has not completed its correction. This vertical run that happened during the COVID period, that needs to be corrected at least 2,000, if not 1,800. Those levels are best levels to buy. So between 2,000 and 1,800, it would be an attractive buy, then buy it into it.
Okay, got that. That's on SRF. Sharad, yesterday we also got the export data which came out for May, and it was quite disappointing for some of these companies. For most of them, actually, names like SRF have lost around 17% on a year-over-year basis. How much of a concern do you think this is, and is that reason enough to stay away from the stock?
Yeah, the export data has been bad for many chemical companies. But I don't think you should read too much into it because these are companies that have done very well over the last, say, more than a decade or so. SRF we have been tracking for quite some time now, from being just a tire cord chemical manufacturer to this level where they have so much of an R&D edge actually. I think this is one of the few companies in India which has such a strong R&D edge, because of which some of the fluorochem products, that they are the only producers in the country to make those products. And fluorination is complex chemistry, and the chemical business roughly makes up around 48-49% of the top line. And the other part that's been soft actually is been the flexible packaging, or the packaging business, where they have BOPP, BOPET, and aluminum foils as well. That is a business that is underway, that has undergone some correction across the globe, and most of the companies dedicated to flexible packaging have also seen some correction, and they might remain soft for say another quarter or so. But beyond that, I think packaging would more or less base out, and that portion should also start contributing. And the company is also planning around a 15,000 crore capex over the next 3 years, which is very substantial given the current size of the company. And most of the capex is going to happen on the chemical side. So if you're a long-term investor and you can wait it out, I think valuations are not very attractive at this point in time. But even conservatively, I think it should trade at somewhere around 25 times FY25 earnings, which should be around 100 rupees, so 2,500. And I think beyond that, as we see more impact of the fluorination and your hydrogen businesses starting to generate money, I think fluorination is something that will receive a lot of impetus from hydrogen businesses also. So beyond FY25, you could start seeing benefits of that also coming in, and market being able to realize that. So I think in the long term, a company that has an R&D edge has been strong in terms of retaining manpower and nurturing manpower. The transition has been very good. So I think initially, conservatively, for a target of 2,500. And I think by the time we reach that target, we might have further developments which could take it much higher from current levels.
Okay, all right, Rajat as well as Sharad. On that note, we're going to thank you all. Thanks very much for joining in and answering a lot of those queries that we had today. We need to take a short break on your stocks, but a quick programming reminder as we do that. And as we slip into that break, you can catch all the developments at the US IBC India Idea Summit 2023 through the day today only on CNBC TV 18.